Hi, hello, good evening, friends. Welcome everyone to Nifty Banker 2.0, India's first retail index traders online conference. I am Ashok Devanampriya, the CEO of Traders Gurukul, and also the host for your today's program. It's a great pleasure to see friends joining in great numbers. Let me thank our media partner, Money Control Pro, the largest financial portal in India with millions of daily readership on their website, who helped us to reach a wider audience through their Money Control Pro program. I would also like to appreciate our title sponsor Espresso, the Sharekhan company, one of the leading discount brokers in India, who have joined us as a title sponsor. The speaker for today is Mr. Prashant Mullick. I'm sorry, Dr. Prashant Mullick from Mumbai. He got his doctorate in chemical engineering from the University of Illinois, USA. He did his PhD in material science and research. He is a co-founder of this company called QC Alpha, which is predominantly focused in the building of strategies for HNI clients as well as prop desk of broker firms. He is going to empower us today with his interesting topic, Nifty Mean Reversion Story. Dr. Prashant, it's a great pleasure to have you on board today. On behalf of Traders Gurukul, Money Control Pro, Espresso, I extend my warm welcome to you into this program as an elite speaker. Go ahead, sir. The stage is yours.
Thank you, Ashok. Thank you for the generous introduction. Guys, first of all, I want to just thank you guys for inviting me to share some of the ideas and some of the things that we work on and the approach we take to the markets in terms of analyzing and building strategies. So what I will do in today's session is talk a little bit about our approach and how we do things, not necessarily specifically giving you something that you can take and start trading tomorrow, but definitely an approach which you can start thinking about and use in the development of your trading strategies. So with that, I'd like to just start with something of a story that we'll go through. It's a Nifty mean reversion story. And just before I was going to start today, Alok, my partner, he messaged me about some more data that he plucked out of the last 10 years for Nifty, which reinforces this mean reversion that we see in Nifty. So with that, Ashok, you want to just talk through some of the
Yes. So friends, the official title sponsor of Nifty Banker 2.0 is Espresso, the Sharekhan company. More details will be shown once the learning part ends. Thank you.
Appreciate it. Thank you, Ashok. So just a very quick intro about myself. I am a co-founder at QC Alpha. We are a market research firm that works on building, investing and trading strategies for the Indian financial markets. We work on both the investing side, where we have portfolios for investing on a more long-term basis, and then trading strategies which are trading the markets on an intraday basis as well as on a positional time frame that might last maybe 5-10 days or so on. My background is not specifically from the financial markets, and I'll talk a little bit about how I got into the markets a little later on in the presentation. But I have done my PhD in engineering, where I worked in material science, and some of you might be aware of how random motion or Brownian motion is one of the aspects of how the markets are observed to behave. But that's pretty much the only connection. I got into trading the markets very early on during my graduate school, and then from there moved out of the markets. Did a lot of wrong things, tried to do a bunch of things that mistakes that a lot of us make when we're starting out, and sort of figured that the markets might not be something for me. This was way back in 99, 2000, and the dot-com bubble and bust beyond that. the next 7-8 years I spent, working in the technical field of my core specialization. And then in 2009 and 10 is when I started thinking about how I can use some of these analytic skills and build some information about the markets and extract some of that information from the financial markets. Right. So I've been working with our team at QC Alpha in the ideation and the building of our quantitative strategies. And once my work is done, the ideas and strategies go into something that we call forward testing, and then eventually into production. And the time cycle for doing that is anywhere close to can be from 3 months down all the way up to 9 months. We've had 4 testing of strategies that go on for about 4-5 months before we roll it out to production. So I will be talking about our approach on some of the aspects of how we do things, and in this presentation. So let's get going. Okay. So this chart is familiar to almost everybody who's watching this, right? It's the Nifty, the last 15 years, and what a run, right? It's generally upward sloping. You have some very serious drawdowns in there, some very serious corrections, and pretty much what's happening in the last 4 or 5 days is like a blip out there, right? Nifty is a very popular instrument for building a lot of traders who are doing systematic strategies in the trend following space, right? You see a very clear trend in this chart as well. If you look all through the years, the last 15 years, it's a very clear trend in the upward direction. But you have a lot of ups and downs in there. And if you go down to the daily or even a slightly lower time frame, one of the things that pops out, and we'll talk through this in the data as well, is how this index shows a lot of mean reversion characteristics, and we'll talk through some of those. What I'll do is there is a lot of some theory in there in the presentation, and I'll go through all of that. I'll try and be slow as I'm talking through this. But anything that you don't gather right up front, please write it down. Push out your questions out to Ashok, and we'll try and spend a lot of time towards the end on questions or discussions, things that you might not agree with me, things that you might agree with me. We will try and keep it interactive. Okay. So before we get into whether building a mean reversion or a trend following or whatever, let's talk about systematic trading. Why do we want to build a system, and what makes a system? One of the things that I mentioned earlier on in my early stint as trying to be a trader, I made a lot of foolish decisions. These were things like trying to trade on news, CNBC news, trying to trade on what somebody who's a friend of mine, what he's trying to tell me to, this looks strong, this looks weak, XYZ. Trying to trade on just looking at some charts and doing, making estimates of what might happen, creating a view of the markets and so on, market kya lagta hai kind of trades. And very quickly I found out that it's not going to work. I was lucky enough to find that out when I didn't have much at stake. A lot of people are not, and I was lucky to get to that realization when I pretty much had almost nothing at stake in the markets. But I did step back for quite a few years when I did realize that this is going to need a lot more information, a lot more analysis, and so on, and try and do something for a living in the markets. But getting to what is a system? It's a set of rules that you have looked at from a statistical significance point of view for the markets. the markets go through various regimes, various types of behaviors, and there's always going to be a situation where you are trying to extract an edge from the market, but there's someone else on the other side who is trying to do the same thing. So if you find something that works in the market, there's going to be other people who's going to find that as well. They're probably going to be faster than you in trading that. They might be better in terms of executing what you found, and eventually that information gets arbitraged away, right? But there are time frames across which a lot of this information is persists in the marketplace, and that is where building a system which takes these kind of trades every time it shows up, without any discretion, without any feelings of whether this might work or not work, and so on. And that's where systematic trading plays a big role for anybody who's trying to do this for a living. I'm not saying that there aren't discretionary traders. I'm sure there are discretionary traders in the audience as well who who have a very good feeling of what the markets are doing, and they might be able to trade. But if you want to do this over the long term, where you are putting serious money at risk, then you do want to do it with a system which you can quantify. And that's what is I feel is one of the big factors that will help you or anybody stay in the markets in the long term, is quantify. What I mean by quantify is will be a lot more evident as we go through this presentation. But it's all about the data that comes in. How are you analyzing it? Whether an idea that you come up with has any significance or not. Whether you have something that you found is just an offhand, by chance, or is there something more than chance that is involved in you being able to capture this? And this is very important because a lot of traders who start, who begin their journey, they might get into an initial phase where everything works for them. And I think that's one of the even more dangerous things that can happen to a trader who's starting out is they try their hand at something. They haven't gone through the testing of this. They haven't gone through how it has worked in the past and things like that, and it just works. They find themselves in an environment where whatever they're doing really works, and that can lead to confidence or in the traders, where you might feel that, okay, this is something that I can scale up, and the moment you scale up, the market regime changes, and shit hits the fan, as they say, right? And this is something to be really careful, in most times, but even more so now in the current environment. Especially because what we've seen in the last 1.5 years post-COVID, where the markets have been on a tear, right? Directionally, it's just one-way markets. People who are trading non-directional in terms of trading volatility, again, it's just one way. Volatility has been collapsing all the way through the last 1.5 years. And pretty much anything you do in terms of selling volatility or trading direction, mostly on the long side, people have made money, right? And so if traders are at the brink of scaling up on things that have worked in the last 1 year, then you got to be careful in terms of what might happen as we move forward in time. Okay, right? So there are a few things that I will talk about which might be controversial to a lot of people, a lot of traders out here, and might be different from what you've heard in the past few sessions. And let's have a discussion on that. If there are questions along those, we can talk about them. And I think the most controversial one is going to be regarding my next slide, which is the dreaded stop loss. And I think this is an idea that that a lot of people struggle with. Is how do I use a stop loss? Where do I use a stop loss? The market keeps finding my stop losses. It keeps hurting me. Are these stop losses going to be how far should I keep them? X, Y, Z. Right? All these questions are on stop losses. My approach to this is really that it depends on your system. For the kind of systems that I'm going to talk about here, we don't use price stop losses at all. We feel that using a price stop loss ends up with bloody hands. I have this thing on the screen here, which this person's hand is bloody, but you end up hurting yourself. They work great, but they're very expensive. They tend to hurt the system that you build, especially the types of systems I'm talking about. We find it that it's better to use position sizing and option hedges instead of having stop losses. So this is one of the things that might be very different from what you've heard, in other sessions or in general regarding trading, where you have to have a stop loss. So let me just throw it out there. Controversy or not, we can talk about it, right? So in what we do, we don't use price stop losses, but rather we have time stop losses. We have a trade setup that has a certain time duration. In that time duration, it works out or it doesn't work out, and we take care of the risk using position sizing and option hedges. Okay. So where does it all start?
Prashant,
Yeah, sure.
Small request. Somehow these slides at the bottom is getting cut. Is there something we can do? Are you able to see the bottom full? All the logos are coming.
I can see it, but if you can't, there was that screen sharing that I was doing, which said which might help. Just hold on.
See if you can change the slide setting.
Yeah. Let me try this again. Okay. I'm going to share my screen again.
Yeah.
And start the presentation.
Okay, superb. Perfect it is. Thank you.
It's better now?
Sir,
Okay.
go ahead.
Okay, great. So yeah, so moving on from this topic, we'll have a discussion on this. I'll take questions on it as well. But whenever you are building a system, where do you start? Right? And it all starts with an idea. What is your idea about what you are trying to do in the marketplace? You come up with a hypothesis, and you take that hypothesis. You find data in the past for where that hypothesis might be able to be tested. And it needs to be testable. It needs to be quantifiable. Obviously, it can't be things like what you feel that is happening in the marketplace, right? Because it's very difficult to quantify feelings. Maybe somebody can do it, but I haven't been able to find a way to quantify feelings. And because there are so many different factors that affect your feelings, right? So, but beyond that, your hypothesis is your basis of everything that you do in terms of building your trading strategy. And once you have that hypothesis, obviously you've got to go back and find the data where that hypothesis can be tested. What is the time frame for this? What are the inputs that you will need for testing your hypothesis? And what kinds of outcomes are you looking for? What are the ways in which you can quantify the performance metrics for the outcomes, right? And that whole process of doing that is what you call backtesting. So you're trying to answer a few questions when you're doing backtesting. This really is the bedrock of everything that you can do in terms of building your trading strategy. I can't stress how important this is, because you can go wrong in number of ways in trying to do backtesting. We've gone wrong in number of ways in trying to do backtesting of our strategies. So what you really want to try and answer are a few important questions. One is your hypothesis valid historically?